All right, Dave, we are up and running. How are you, man?
I'm doing wonderful. This is a new setup for me. I'm a happy camper now.
We'll get you happy one way or another. Yeah, so you should have seen when I had McNee on here for the first time. We used this software, and I had a glitch, and we had an utter mess. It was not so pretty. Not definitely not so pretty. Wasn't overly happy. But everybody, if you can hear us, please say hello and let me know how you're doing, and we will definitely get going. And in fact, let me go ahead and introduce who we are and what we do. You guys know, of course, we are the TBWS Group. We are the largest provider of mortgage-backed security information in the space. We're the king of MBS. What we've done, though, really is take mortgage-backed security information and use it not only to help you protect your pipeline in the conventional sense, but also with a lot of cool tools to share it, social media, marketing, and I will actually stay after the webinar and share that, tell you guys some more about that. Today, joining me out of our faculty is David Schurmeyer, our MBS expert, man that I respect tremendously. And if you have any questions, I encourage you to go ahead and chat in the chat box and say hello. In fact, let me see. I don't think that was enabled. There we go. Now that is enabled, you can go ahead and say hello. Everybody can chat in there. I love to encourage that interaction places we're going along. And remember, you can go ahead and send things both publicly and privately so that only I'll see them directly. And of course, we want to welcome all of our members. What used to be Rate Alert is now 1003 Magnet, and MBS Authority wanted to go ahead and welcome everybody. So what is RateMastery? Well, this is our opportunity to take 30 minutes out of your day and to educate you on the markets, on what's driving mortgage rates, and especially right now, what really makes that relevant, and let me go ahead and pull that up, what really makes that relevant is what's going on in the market today. And you know, the last few weeks, I'm going to go ahead, this is our new system, by the way. This is our magnet system. For those of you that are joining me from our corporate solutions, I want to welcome you and thank you for coming. Your companies provide this to you at absolutely no charge. For everybody else that's joining us, there is an individual subscriber basis that you can go ahead and purchase this on through 1003 Magnet, and I'll actually share that with you guys later in the webinar. But this is our platform for mortgage-backed security data. And Dave, I know I'm doing a lot of the upfront talk, and I'm going to turn this over to you in a minute. But what I want to point out to everybody, what we're going to talk about today, is through starting in April, we had an amazing run-up in mortgage-backed securities. It brought with it some fantastic rates. We talked a lot about Russia and the Ukraine and some weakness in the Chinese economy. We talked about weakness in the European Union and what the European Central Bank was going to need to do to fight deflation. And all of this has been really helping the mortgage-backed security market. On top of that, Dave, you were talking something that was a little bit over my head, and maybe you can explain it before we get too far, about people buying treasuries at the end of the month and how that helped mortgage rates. So let's start there. What was this whole buying things at the end of the month, and how did that help mortgage rates?
I don't know. I don't know who you're talking to or about. I don't recall making that comment. However, at the end of the month, at the end of this month, you might see a little bit of that because it's the end of the quarter. Um, Maybe it was Brian that was referring to
No,
that.
I remember it was in your commentary. It was probably Tuesdays. So, but that's okay. Really, I guess what the main thing is why did we see such a drop in mortgage-backed securities between, May 29th, which was what was that, Thursday, and then it really just slammed down. What happened to mortgage-backed securities, and where did our support go?
Well, it's the old adage of buy the rumor and sell the fact, if you will. Uh, the markets were discounting a lot of the events that we've gone through here in the last few days or so. Secondly, Ukraine and Russia, which was a fueling point for safe haven moves into treasuries, that has somewhat abated recently. The problem is still there, but the markets, not only here but Europe and around the world, are now seeing this as a regional thing that probably will be contained in a regional manner and not fester and involve civil wars and things of that nature. So a little bit of that buying has somewhat abated at this point. Then you have the markets after this tremendous run-up from a technical point of view became extremely overbought. Looking at your right there on the screen, the relative strength index, you can see how it was pushing into the overbought level. And then add into that, we come into this week with an awful lot of economic data and two major events, one of which just occurred today with the European Central Bank, and of course tomorrow's May employment report. So this pullback from a technical point of view isn't necessarily, at this point anyway, that scary. This morning we opened up in a very weak fashion, and the market held. We've got a rally in the stock market going on, as at the same time we're seeing the interest rate markets improve a little bit. The economic data and two major events, one of which... What just happened?
I'm playing you on my other computer. Go ahead. I like to monitor it from, guys, I monitor this. You know, I'm a tech guy, so I, of course, have like 3 computers. I got Windows, I got Apple, I've got every device known to man. And actually, I was watching the webinar from your point of view to see how it's going. So go ahead, keep talking, Dave.
Well, it looks like we're into, into a lot of issues here at our end. But I was beginning to talk about the European Central Bank. For a month now, a month ago, Mario Draghi, who is the president of the European Central Bank, when they had their meeting in May, made it relatively clear as anything from any central bank, that they were about to launch some sort of additional help in order to stimulate their economy and keep the deflation from continuing to grow. Well, that meeting occurred today, and the European Central Bank pretty much did what the markets were expecting. So again, kind of like buy the rumor, sell the fact. They lowered their interest rates that they charged from, let's see, from 0.25% to 0.15%. That's what they charged, like our Fed funds rate. They also cut their reserve. They used to pay about a 0.1% or about 1% to the banks that were holding money in the reserve, similar to our banks parking their money in the Federal Reserve. Well, now that's going to cost the banks a 0.1% or 10 basis points, and the idea being that if the banks have to pay to stash their money, that they might better off find some place to lend it and improve the economy. There are also some issues about, first of all, Europe doesn't have securitization like we do here, mortgage-backed securities, CDOs, and various things like that. But they're going to, it sounds to me like they're going to develop that. And when they do, then, of course, they'll be able to buy these securities from the banks, similar to what our Fed's doing. Thing is, they're about 3 years, 4 years behind time. They should have been doing this a long time ago. The economy still now, in our case, the United States economy comes back more in focus. We've discounted what the ECB has done. That's already been discounted in the market. Now we're going to see what really the status of our economy is. And as everybody knows, it was not good in the first quarter. First quarter GDP was a negative 1%. Now that's coming on the preliminary report. We're going to get the final report on it come towards the latter part of this month. But it's still going to be negative, even if it's not 1%. It's still going to be a minus. And now we're focusing, of course, on the second quarter. The other day, we got the trade balance for the month of April that was substantially larger than what the markets were looking for. It was $47.2 billion. Markets were looking for $40 billion or thereabouts. That's going to be a negative. You could put that in the negative column for the second quarter GDP. Not necessarily that is going to make the GDP negative, but it's one strike against a lot of the things that go into making up the GDP. So we're back to the economy at this point in time, and I don't see rates going much higher, but at the same time, it's gonna take an awful lot of push in order to get those rates back down there and keep them down there. The one thing that we're waiting for, and those of you who read our stuff every day or at least periodically, you know that I'm pretty bearish about the outlook for the stock market. It keeps going higher. I understand that, and I certainly can't tell you when it's going to happen, but this market is setting up for a huge correction, and I don't mean just a little one. It's probably going to be pretty severe, whether it's next week, 3 weeks from now, or 3 months from now, but it's coming, and if and when that does occur, or when it does occur, we're going to see these rates benefit, again, by safe haven moves. So that's pretty much where we are right now. Waiting now for the employment report tomorrow. And that's always a walk on the wild side in terms of comparing the reality to the estimates.
Now, do you think that the employment report isn't as important as it was with all the Fed tapering talk? Now that everybody knows that the Fed is definitely going to taper, do we still have that same importance to the employment?
Oh, definitely. You're always going to have that to be probably the most significant monthly report that we see every month. Certainly, as you mentioned, the tapering is over. Well, it's not over, but it's certainly over in the sense that the market understands that each month they're going to take 10 more billion out of it. The thing that we're not paying too much attention to these days in the markets from a trader's point of view is the unemployment rate. That is probably the least important thing that we need to focus on in terms of really measuring what the employment situation is. As most of you know, it's a telephone survey, and if a person that they call says they aren't looking for a job, or that they haven't looked for a job for a month, they no longer exist. They're like, you know, they're invisible. So the more that people respond that way, or say that they're going to retire, particularly the baby boomers and so on, that has a tendency to push that unemployment rate down. But where we really have to focus on and continue to focus on are the job creations. Yesterday, ADP reported an increase of 179,000 private jobs. The markets were expecting ADP to report something about like 210,000.
Right, but you and I both know the ADP report never seems to match what comes out on Fridays on payrolls and stuff.
No, it doesn't. It's way off, but it's off mainly because of the way that the data is compiled between the BLS and ADP. ADP basically writes checks and does payroll for lots and lots of companies, and so their calculations are based a little bit more simply. Excuse me. But the point I want to make is that in that ADP report yesterday, of the 179,000 jobs created, 150,000 of those were in the service sector. And it's no secret that the service sector is the lowest paying sector that we have, and it generally is made up of wait staffs and store clerks and people like that, or jobs like that don't pay a whole lot of money. So these are the things that investors are wrestling with here. Okay, the headlines in the paper, if we get a 6.3 unemployment rate, it's supposed to be 6.4. But if it comes into 6.3 or 6.4, that makes the media and the headlines look really, really good. But the key is, what kind of jobs are we creating? And so far, the job growth, while it's been nice on the numbers, it's not nice in terms of the types of jobs that we're doing.
Well, I mean, that's a conversation we could have all over the place. So when you talk about the type of jobs,
that's what the markets worry about all the time. Yeah.
Well, I mean, and that's it. And do you think that's why right now the biggest question that I would say everybody has is, we saw, we saw the best rates of 2014, but we've got an inventory problem in many sections of the U.S. Do you think that we continue to see rates go back down, Dave? I mean, looking at what's going on today, we're up 27 basis points now. We've got a real nice bounce back. And does that continue? Do you think we peak? Like, where did we peak on these? We were for the 3.5. We were at a high of 103.36, but it actually, the highest that we opened was 102.71. Do you think that we get back up there, or have we seen the best we're going to see?
Well, in what time frame? But actually, the near-term answer is tomorrow will tell the tale about that. If this employment report doesn't show the kind of job growth that the markets are anticipating, about 215,000 jobs, both for private and for non-farm payroll, if we get something less than that, we're gonna see these rates come back down a little bit here. But when you go back and look where the low rates were, or the low prices, to get way back in whatever that is on your chart there, I can't see the dates, but where we got down to the par level on the 3.5 coupon.
Let's see. That was probably back in April, March, April.
Yeah. Okay. I don't see that. I don't see that until or unless the stock market does what I think it's going to do at some eventual time. And if, by golly, if I knew when that was going to occur, I'd only work for one more day after I made a killing. But but as far as answer the question, we'll see what happens tomorrow. The markets, we're seeing numbers now that are less than the numbers that we saw in the previous month. For example, ADP that we just talked about from yesterday, they showed jobs at 220,000 in April. Now we're seeing them say 179,000. And if we see that kind of a trend in the employment report tomorrow, I think you'll see some bond buying going on and get these yields back down. But the larger, bigger macro picture is that it's going to be difficult to hold rates at the levels that we're currently seeing, or at least what we saw here a few weeks ago when the 10-year note got down to about 240. It's never going to stay that low unless there's a real somewhat of a crisis that no one really wants to anticipate.
So why are we getting a run-up today in front of the jobs report? And do you think that we're going to be able to hold these gains through the day, or do you think we close and we lose some of this?
No, I think we'll hold them through the day. We're pretty close to the end of the day, really, in some sense. Why we're doing it, I think that what the ECB announced, even though it was mostly discounted in the market, and most of the analysts and the economists pretty much expected about everything that they had announced, except for the fact that they didn't put both feet in the water and say, okay, we're going to start really flooding the economies over there with money like we did with the Fed. The Fed, of course, has a $1.4 trillion balance sheet, and some people, and I think a lot of the deep thinkers, think that the ECB, while they did something positive this time, didn't do enough. And the initial reaction, if you watched the trade this morning at 7:30 when the ECB announced what they were going to do, we had a pretty decent sell-off. The 10-year note yield shot up to 265, and it's back to, I think, about 260 now. You're blocking my screen, but that's okay.
Well, yeah, actually, we've got it on ours, and we've got right now, we show it 2.58.
Yeah, okay, 258, and that's a pretty big drop from the knee-jerk reaction that we saw earlier this morning. But once people, the way I interpret what happened today is that once the markets took a good deep look at what the ECB did, or what they announced that they were going to do, they were disappointed that they didn't do enough, or however you want to phrase it. Consequently, Now we saw a reversal, and we're looking pretty good. I think we'll hold this. Whether it sticks tomorrow is another matter, of course.
What would we be looking out for next week? We knew that the news this week was the European Central Bank, and then the jobs, the employment reports. What are we looking at for next week?
Well, for one thing, I think we have auctions coming up, a 3, 10, and 30-year auction in the Treasury market. As far as that is concerned, I haven't looked at it, to be truthful with you. Let me just bring it up.
While you're bringing that up, was it anticlimactic with all the talk about what the ECB was going to do and Draga and the whole deflation thing, and then it was just, I mean, I know it's a big deal that they went negative so that banks don't harbor their money, but even still, there was talk of, I don't know whether it's true quantitative easing or something very similar, over there that didn't seem to get done, and it looked like there was just a ho-hum reaction. Was it because everything was already priced in, or was it really just not what, as big as everyone thought it was going to be?
Well, I think you're right about the fact that it wasn't as big as what everybody thought it was going to be. And trying to bring this up. As I said, I think many people in the markets were expecting a stronger statement that we're going to start pitching money out in the manner that the Fed did. Well, as I said, first of all, they don't have securitization over there in Europe, similar to what we do here, so it's a little bit more difficult at this point for the ECB to step up and say, okay, we'll buy your, like the Fed has been doing, buying mortgage-backed securities and buying treasuries. I think the market was a little disappointed with that, yeah.
So what do we come up with next week? Rates going down in the twos?
The what?
The twos, 2.75, 2.875.
Well, we're gonna not get to the threes if that's what you're.
I wanted to just bypass the threes, go right to the twos, try to get some refinances going.
Well, you're talking the mortgage rate. I was thinking you were talking treasuries.
No, I'm talking the mortgage rates.
I don't think we're going to get much better with what we can see now. I don't think we can see much better than what we saw when the rates hit those lows back in early February. At least in the context of, let's say, the next 30 days. Okay, I'm looking at the calendar for next week. We got the auctions, as I said. We got retail sales comes on next Thursday. Most of the data is pretty anemic for next week. There really isn't a whole lot on here. A bunch of Fed speakers, business inventories, nothing of rocket moving type stuff. Producer price index on Friday the 13th, by the way. So not much that we can see on the calendar that would get our focus. But again, Europe's in play, China is in play. We're in a global market now, and as a consequence, you just simply cannot totally focus everything on how our economy is doing. I see a question here. You're showing the 3.5 coupon.
Yeah, we are showing the 3.5 coupon.
Well, I don't know why you address that to. Oh,
it's to everybody.
I'm not. I'm still sticking with the 4 in terms of our work, and the reason for that is that in tracking the prices that the lenders are putting out every morning when they price, it appears at this juncture that they're still pricing to the 4s. I'm keeping track of the movement of the 3.5 and the 4 coupon and adjusting it or pairing it with what's happening from the lenders like Chase or Wells Fargo or BB&T and on and on and on. It appears they're still pricing to the 4 coupon, and there's been a big spread between the two, or a big gap recently between the 4s and the 3.5s, which gives me more confidence that they're still pricing to the 4.
Has there been a big gap between those?
Oh, by the way, look at your problems on your 4 coupon there.
Oh yeah, look at that. It looks like paint that fell down. Oh, I'll bring that up to the developers. Let's go back to the 3.5. It looked much prettier.
Yeah, it's but right now they seem to be priced into the fours, and we'll move to the 3.5 when it becomes evident. And what happened yesterday and today, like the three, I didn't make a note of it, but the 3.5 coupon is a lot stronger now than the 4 in today's market. Can you bring up that dashboard?
Yeah. Which dashboard do you want?
Well, the one that there. Well, see, 38 basis points on the 3.5,
We're
and
still jumping.
on the
Yeah.
4, it's about 22 basis points.
Right, but they're still. I mean, they're both still positive.
Oh yeah, yeah, they're both positive, but if they were pricing to the 3.5, we would see these kind of gains showing up in repricing and stuff, and we're not. I mean, we're getting repriced, but we're getting repriced at the levels that the 4 is moving.
So, Paul Zagaris asked, do you think the treasuries will go down that much with all of the policies the government is implementing? It trending seems that it's going the other way.
Tries to go down that. And I wonder if he's speaking about price or yield.
I would think yield.
No, I don't. It's going to take something really serious to drive these rates lower than we saw in the early part of April. That seriousness could be this major correction in the stock market that I think is going to happen. But as I also said, I don't know when. And I certainly am not going to want to recommend shorting stocks until we see it actually turn over. And that may be a long time. I mean, the Fed has got us in a situation where the only thing you can do to make any kind of return on an investment is buy equities. That was their game plan, and it's worked quite successfully. New highs in the S&P, new highs in the Dow. Just continue to plow forward because there's no other place to go to make any kind of return of any consequence.
Got it. All right, so as we come up towards that half an hour, any closing words for everybody?
Well, watch the employment report real close. If it's weaker than the markets are looking for, then I think you're in a position that you could expect to see these prices go higher and the yields go lower. But if, on the other hand, it's a stronger employment report, I think we're just not going to see this happen. So we'll see what happens tomorrow. For all the years, 25, 28 years that I've been trading and involved in all of this, the employment report, if you wanted to put a percentage to it, maybe 3% of the time in all of that period of time did the data come out close to where the markets expected it to be. That's why we get such tremendous amount of volatility on the first Friday of every month, because the report typically doesn't match what the consensus is or was, and I'm sure that'll be the case again tomorrow.
You'd think after all these years somebody would be able to find a way to get it right.
Well, you know what? It's awful hard for the BLS when you really think about it. At the end of the first week of the month, they're supposed to have an accurate count of the employment situation for the previous 30 days. I mean, look at the government's way of messing up the VA hospitals and a few other things. And that's another thing that gets everybody upset, because it's more or less the revisions that seem to carry a lot of weight too, and we have to watch for that tomorrow. See what they revise last month's figures. If they rise them better and we get better data than the markets are looking for right now, we're going to see some selling in the treasuries and in the mortgage backs.
And let's see. Eugene, you just put in the comment box, you're confused. You refreshed. Your 3.5 bond is lower at 102.515 and not 102.58. How is there that much lag or difference? Well, actually, the reality is that basis points are not what the market is traded in. It's actually 30 seconds. So 0.515 would round to 0.52. So you're talking 6 basis points, which is actually 230 seconds. So that could be, the difference between. What are you comparing that to, or if are you comparing it to mine to yours? I haven't refreshed mine, so that could absolutely change 6 basis points or 2 ticks in no time flat.
Eugene liked my market recommendation in the report last night.
Why? What was the recommendation that you?
I don't normally give recommendations, but
when you did tell everybody they should invest so that they could recycle aluminum. I did.
Yeah,
I of course I edited the content and I love that one myself.
It's the beer that's important.
It's the beer. So
I'm damn proud to be an American.
There you are, man. Well, Dave, feel free to stay, and thank you again for joining us and sharing all that stuff with us. And I'm going to take a few minutes and actually go through the site for anybody that had asked. There had been a request before about going over some of the marketing. So first and foremost, for any of our corporate solution clients, thanks again for joining us today. If there's anything you'd like to learn from this, it's fantastic. I know we do have a lot of people that we share RateMastery with that are not 1003 Magnet subscribers, and they'd like to find out more about 1003. So you'll see up to the right of your screen. Yeah, check that out.
Can I ask a question before I get off?
You can, but if I don't like it, I won't answer it.
Well, I didn't understand what that was. I thought it was Tino 3.
It's 1003. That's Tim Kearns, the CEO. He wanted something that really emphasized what the purpose of what we do is, to help you to attract business. And obviously loan applications in the industry, we tend to call them 1003s. And that was Jason Lutz turned it into that very artistic logo, 1003 Magnet.
I think they should put a space between the N and the O.
Okay. It's a good thing you're not the graphic designer. Oh, well, we lost Dave, everybody. Oh, no, we lost. All right, that's all right. So, hey,
y'all have a good day. I got to get off of here now.
You go ahead, Dave. Thanks again for joining us. Anybody that'd like to stay on with me for a few minutes, I'm going to go ahead and go through some of the marketing, some of the best practices, especially with how you can use this stuff real quick with sharing it with your consumers, your realtor partners, especially in the volatility of the market that we're experiencing right now, and how best to handle that. So if we take a look, we saw that there was a fantastic run-up in mortgage-backed securities. That, of course, leads to improvement in mortgage pricing and rates. Then we saw a huge drop. This is a difference of 1/8 to 1/4 point in rate right here. Not in pricing, but in rate. How do you protect yourself and your reputation when you're working with your consumer? Well, the way to do that is to make sure that you're maintaining conversation with them. If you click on your marketing center, it'll drop you right on the social share page, which allows you to share any of our content socially on Facebook, Twitter, Google+, or LinkedIn. And I'm actually going to go directly to the email pieces. I'm going to go to the send single piece. You could actually, if you were at a conversation with a consumer today and you wanted to convey to them what was going on in the volatility, you could send them either the weekly piece or the daily piece, and you would do that simply by entering their email address in right here, clicking the daily rate insider or the weekly rate insider, and forwarding that right off to them. And if you want to see some examples of what that content looks like and how to use it, let's go to the daily rate insider. And the daily rate insider is this piece here. 3 simplistic dials that make all the difference in the world. You guys have heard it before. The picture tells 1,000 words. We talk about which way rates are currently trending, which way rates we're forecasting them to go, and then we talk about what the volatility is. And bear with me a moment. I'm going to fire up my email, which will probably take over my screen momentarily. I will pull that right back off, and let me show you today's insider and show you what it was that what was something you could share with today. Now, again, first and foremost, I want to point out that you can take this content, you can co-brand it with your real estate partners, or this, where it says realtor, is actually controlled by whatever title is put in. So if there's no title, it'll default to realtor, but if you do put the title in, it will go ahead and that will fill in up here as well. So you could have CPA, you could have builder, anything you want. Sorry, I had to take a drink. So this is actually the daily market analysis, which is actually it's a edited version of Dave's commentary. Let me go to the Insider. Bear with me a moment, and I will pull up the Insider. Here we go. That is the Daily Rate Insider. Let me pull this one back up. So today's Daily Rate Insider, this is the content that you want to be sharing on a regular basis with your consumer, because it's going to keep them abreast of what's going on in the market, and it's going to protect your reputation. It's going to give you that starting point for a conversation. So we talked about which way rates were currently trending. Well, yesterday they moved 6 basis points, so rates didn't move. They were neutral. Which way do we think they were going to go today? We actually expected things to be quiet. When this was released, the market was only up 6 basis points again. And it wasn't forecasted that we were going to see what I'm going to call a delayed reaction as I go back to the MBS page, where we're up 30 basis points. I mean, that's just such a pleasant surprise. Let's see if we finish the day with that, though, right? And then lastly was the volatility, and that we did figure on. And we know there's lots of volatility. So this is your Cliff Note version. This is just something that they scan and they look at. This looks absolutely fantastic on a cell phone, on a smartphone. Your consumer can access it on an iPad, on a Windows 8 tablet, anything, all right? It's going to look fantastic. Then we go into just a very, very brief breakdown about what goes on. Now, the best part about this is you don't have to put your neck on the chopping block to make that call. You can go ahead and point out to it, and when they go on here, they can click on Sigma Research, and that'll show them, this cool back-end page. Now, for all of you RateMastery members, let me see if I can pull this up, and bear with me a moment. And bear with me. I'm looking for a specific link, and once I find it, you guys are going to absolutely love this. This is what we're working on for you for the RateMastery. And bear with me a minute, actually. Let's see, RateMastery. Bear with me, bear with me, bear with me. Okay, here we go. Check this out, right? So for all of our 1003 Magnet members, for all of our corporate solution members that are on the Magnet system, you're automatically enrolled as a member of RateMastery. And everyone on today's call, this is our RateMastery webinar. But our RateMastery program, if you're a registered RateMastery member, that shows that you have the education and the knowledge about the markets and about, interpreting where mortgage rates are heading and what's going on. Well, I know that some of you really love that CMPS stuff. You want something that validates for a consumer at a glance what you bring to the table. Well, what we're giving for you is we're creating a RateMastery icon. You'll be able to put that on your marketing, your email, your social media, and when somebody goes to the RateMastery page, it's going to take them, when they click that icon, it's going to take them to this page where it's going to show them that you are there protecting them, gives them a quick breakdown of, and just again, in very simple consumer speak, of what it is that you're able to provide for them. And then it's got a wicked cool video, and of course I'm going to say that I did the video, right? But it's got a wicked cool video right here that explains what RateMastery is, and how it works. Talks about their experience. You guys are going to get to see this, right? So I'll just forward through the video real quick, show you a couple of quick. That doesn't even want to do that, so forget it. I'm going to pop that off out of the way. This is something you guys will have that you'll be able to point out to your consumer as you're providing them all this content. That's what we offer these days. It's not just, okay, which direction are things going and protecting your back end. It's sharing that with the consumer. Transparency, protection, all right? So protecting, the consumer, protect themselves against that drop in the market. So when we're up 33 basis points, obviously that's fantastic. They don't have to protect anything that day. But what are we going to do when that market drops back down, when we start to see a few more red lines? That's when you're going to want your consumer to go ahead and protect themselves. So you want to be explaining to them, and the best way to do that, to tie this all together, is if you're sharing that content with them, if you put them on that daily drip, where they're getting the daily rate insider, it makes them feel totally involved in the process, that they see what's going on with the rates. We put it in a very, very simple consumer speak, and we don't tell them anything about rates. We don't quote any kind of rate. We're totally compliant. It's totally Reg Z compliant. You don't have to have an APR on it. We're not talking about anything that uses any trigger terms, and most importantly, we're not giving lock or float advice. We simply give them which way things are trending, which way we think they're going to go, and the volatility that they're going to see, and then we send them right back to you, and we tell them if they're looking for anything to call you. You've got your opportunity to go ahead and put your information in your About Me section. All of your compliant requirements can be filled out in the licensing section, and at the top is your mortgage professional information, all your content. They can share it, you can share it, you can co-brand it. Wicked, wicked cool stuff. So that is hopefully answer some of those questions that we have. If you want, you can go ahead and click the chat tab up at the top again. Click that chat tab. And if you do go ahead and click that chat tab, that will go ahead and put you back into the chat box, and you can go ahead and answer any questions. So let's see. Leanne says, I thought that if I uploaded a realtor picture that when they get my email, they could use that for joint marketing to their clients. My realtor said their picture wasn't on there. Let me show you exactly how you go ahead and do that and how you'll get that to happen. First and foremost, there's two different kinds of contacts, realtor contacts and consumer contacts. Realtor contacts allow you the ability to go ahead and when I add a new one, all right, it allows me the ability to go ahead and upload an image, all right, and to upload the information. So let's see. I'm gonna put Sally, Rate Realtor, and Sally at SallySellsHouses.com, and she is a mega realtor. And let's say she works for Romex, right? All right, and that's all we'll fill in for now. Okay, and let me go ahead and pop her picture in here because we're going to make Sally look like David Schurmeyer. How's that, right? Because David's up here on my thing. We're going to make Sally look like David Schurmeyer. Let's pop Sally/David Schurmeyer in there. And actually, I don't want to make Sally look like David. Let's make it David Rate Realtor, right? So David Schurmeyer, our Rate Realtor, and we'll make it David at David Sells Houses. Why? Because I don't want to do that to poor Dave, make him Sally, right? So we got Dave at David Sells Houses. We got his picture. Now, I can give him our realtor-specific marketing content, which has a special realtor marketing piece on there. Okay, and I'm going to add him. He's going to start receiving that. Now, let's go ahead and we're going to add Dave as a consumer, and this is how you make sure that Dave receives the co-branded piece with himself. So we're going to take Dave, and I forget what we call him, Rate Realtor, right? All right, and it was David at davidsellshouses.com. Now, you select the referral source, and as this drop down is all of the realtors and referral partners you put in. So you take and you put David in as a consumer with himself selected as the referral partner, and you send him the weekly, and I'm going to send him the daily rate insider as well. Okay? And if you want to see examples of that, you can go ahead and click the example screen, and that will bring that up. So now I add that. So now once you've done that, Leanne, then it will go ahead and it will be on there. So if you now, Leanne, are you saying that when it's on the picture isn't there, but is the content, is the information there? Let me know if the information is there. If this whole section is blank, that means that you're just sending them a piece. It's not co-branded. If their information is there but not an image, then do me a favor and go ahead and contact support, and they would help you get that resolved. If there was any kind of a glitch or an issue like that, I've never heard of that. I don't quite know what that would be, but we have a full member support staff that is there to help everybody, and you can contact them. The information's at the bottom of the page, 707-356-8297, or support@tbwsmail.com. But I think, yeah, see, so you got what I'm talking about then, about unloading them and popping them back in there. Awesome. That's fantastic. And are there any other questions or best practices that you guys want to discuss or talk about on this? Now, forgive me because there's a little bit of a delay, believe it or not, between what I'm saying and what you're hearing. So I'm going to wait about 30 seconds. I'm going to kind of fill that with some empty air, and I'm going to type this in there. Are there any more questions? And then I pop that on there. Karen, I'm still here, guys. I am answering something in the comment section. And awesome. Let's see. Dave says pricing's currently following the 4.0 coupon. Why do we show the 3.5 and how can we change? Well, you know what, guys? Dave is following the 4. A lot of other analysts, including Brian McNee, are covering the 3.5. As a whole, we're covering the 3.5 to be the most relevant coupon, the closest to par, as well as the one that people are selling into. And not to take anything away from Schurmeyer, totally respect him. There's not usually that big of a movement between the two, and right now the 3.5 rates are generally about a half a point higher than the coupon, and right now our rates are at 4 to 4.25, so it's kind of really it should be the 3.5. I mean, the 4.0 coupon is when we're up at around 4.5 to 4 5/8, but it's also volume, and there's a lot of things. If you want to go ahead and take a look at the 4.0, you could choose it from the drop down box here. That'll show you the Japanese candlestick chart for the 4.0. Is there a way to snapshot the graphs? Absolutely. I'm a big proponent of Jing. Let me remove this sticky. Coolest program for screenshots ever. www.jingproject.com. And it is free. All right, so let me go ahead and display that. The coolest program for screenshots ever, jingproject.com. It's made by TechSmith, and it is free. Absolutely awesome. How do you edit info on the consumer page? Which info, Mike, are you looking at? Mike, your info or the consumer info? And again, this is a best practices, just an extra add-on to the webinar. I don't want to hold anybody up. If you want, welcome to stay with us. Love to have you. If you do not have 1003 Magnet, the system we're currently talking about and using, by all means, you can actually try it out for $1. For $1, you can run it for 30 days. See just how amazing it is. You'll absolutely find that it's going to floor you. Great, great system. I got that back up for you. Let's take a look and see what Mike's answer is. And I'll try to answer both of those questions while I wait to hear back from him. So you can answer your information. I'm sorry, not answer. You can change your information. If you go into your marketing profile, that's where you can edit all of your information. Your name, your first name, your last name, your title, all the information that they see that shows up on the actual, let me pull up the, oh, here it is, pull it on the screen. So all of this information, your personal information, is in your profile. If there's a consumer, you can go ahead and if you click on My Consumers, the list will show up. Now, because I only have one, there's only going to be one. And then if I click View, I can go ahead and open his profile, and I can make any changes to his first name, last name, email, phone number, or change his referral source. I can also take any notes here. Dave is a realtor. I am sending info to help grow my brand. And anything that you want to go ahead and do in there would be right there. So that's where you could change the consumer info. You can change their, if you go in and pick them, view them, change their first name, last name, email, or phone number. And again, why do we keep it simple? This is not a full, customer relationship management system. It's not Salesforce.com. This isn't designed to, this is a purpose-built pre-lock marketing and commentary communication system designed to help you avoid those uncomfortable conversations in today's environment when the market moves and you have to pass that along to the consumer because of Frank Dodd and the inability to absorb anything in your pricing anymore and all that stuff. So there's a big need for it, great need for it, and it's there. So I will put out there one more time. Any more questions? Let's see. Any more questions? Go ahead, and that's in my chat box. If you want to click the chat tab, you can go ahead and type if you have any more questions. And I'm going to quietly sit here and thank everybody for joining me today. Awesome. Well, thank you, everybody. I appreciate you joining us for today and look forward to chatting with you again next week. Make it a great week. Take care.